Hey, good morning. We are live. I'm Conor O'Brien with Kevin Carter. How are you, Kevin?
Great.
Kevin is the architect of EMQQ, which is an ETF many of you who are on this call probably already know. It's very much an emerging market-focused technology ETF. And myself with our team, we created something that sounds similar, but actually I'm going to tell you how different it is. OGIG, the O'Shares Global Internet Giants, which is a blend of large cap, high growth internet stocks in the internet services area. Some are US, some are outside the US, and of those outside the US, split between 20% roughly in China and 20% in other countries. So, Kevin, there's been a lot of noise and news flow out of China. We're going to just do a quick recap for people of a table of the sequence of events, and if the producer could pop that on, it'll just remind people of what the focus was. So there first were comments by central government and changes on the rules applicable to the education technology sector, then some rules and comments on the welfare of delivery workers, meaning food delivery and so on, then online gaming, and then unfair competition and more, and now reductions on how much time kids can spend on their devices playing games. So back to our smiling faces, please. We'll just ask Kevin, you're closer to it than we are. Our view is China needs technology. Yeah, sure. There's some areas where they've essentially eliminated the profit stream, turned these education platforms into nonprofits. According to some other experts who said that was years in the making. Those companies had been forewarned, and they just kept on going, and they milked the cow for as long as they could, and they finally got shut down. However, for core e-commerce, business to business, business to consumer, the country, to meet its own ambitions, needs to embrace technology. And there's a view why those tech companies will continue to be allowed to grow and flourish. But you're closer to it. What are your views of what has happened, and with the policy first, what has happened and what more do you expect to happen on the policy side out of China?
Well, I think the first thing I would say is that if we look at what's going on, not just in China, but all over the world, because this isn't really a China thing, this is a global thing, governments are grappling with big technology, and the platform companies that have exploded in size and importance have, in many cases, outstripped the regulations that are meant to control them. And that is happening in China, but it's also happening here. I mean, the irony of a lot of this is that the day when the fear in China got to its peak, the fear about the Chinese internet companies was July 27th, in my estimation. That was the peak fear day. And the same day that people were running around with their hair on fire, worried about the Chinese government stealing their money, the front page of the New York Times had a piece talking about how Joe Biden had assembled his team of attorneys who specialize in attacking our FANG stocks. So this is happening all over the world, and China is different, and it's different in a couple of ways. First of all, the one thing that I've learned in my 16 years focused on China, Connor, is that everybody, the most prevalent thing I deal with is people are afraid of the Chinese government, that somehow the Chinese government's going to do something and I'm going to lose all my money I invested in these Chinese internet companies. And it's pervasive and it's constant. And so people react very scared when the Chinese government's involved. And I understand that. I don't think they should. I think that you said that China needs technology. Most importantly, they need capitalism, and they know it because they've benefited from it. And so there's this constant battle in people's minds as to whether or not the Chinese government really believes in capitalism, or are they going to somehow steal your money? And so that is, I think, the biggest part of the backdrop. And then the other element is that China is able to do these things very quickly. We have, when we seek to regulate the Facebooks and Amazons, there's lobbying and special interest groups and hearings, and it drags on for years. China is in a unique position to basically pull the emergency brake, make sure that the regulations are in place that are and needed, and that they're being enforced, and then restart. And they've done that, and they're very clearly focused on doing that. But I don't think they're out to kill capitalism. I think they're doing very practical things to serve the long-term interests of the country.
Well, we agree with a few of those things, that they need the technology, they need capitalism. It's enabled them to flourish, and they probably want just a greater degree of control. They want to make sure that the billionaires don't feel like and act like they're more important than the central government. So maybe a little bit of that motivation. One of the strategy experts that we spoke to recently had some additional interesting comments, which is a lot of these recent rules that have popped up in the media have actually been spoken about by the central government for quite a while, and the companies weren't really responding. And so I guess they finally said, enough. Let's change this. Let's talk about valuation here. We have a really interesting chart. I'm going to ask for it to be popped up on the screen, and it shows a multi-year history of relative valuation. So we're using the price to sales ratio of all of the stocks in the OGIG index relative to the price to sales ratio of the stocks in the NASDAQ 100 index. And I bet for the EMQQ, your chart would probably look something like this, that the relative value ratio was hovering around a certain median line for quite a while, and it's recently become extremely cheap, meaning in this case, the stocks that comprise the OGIG index have become the greatest discount in years and years and years. And that the same would probably be true of your stocks. So if you're down 20%, you got to go back up 25% to get back to that median line. Then the next thing I want to really show people is the next slide, which shows, okay, they're cheap, but how the company's doing. This shows you the portfolio weighted average revenue growth over the last 2 years of the stocks in the OGIG index. And so what it shows you is, the revenue growth keeps on going. And so that is a contributor to why the stocks are cheap. The revenue keeps going, but the stock prices softened a little bit. And so in the eyes of many people, this is an opportunity. If the companies are healthier than ever and they're actually at relatively discounted valuations, maybe it actually is a strong indication of an interesting time to invest. What are your thoughts on just that general concept in terms of a time to put money to work now, or should people wait? And what do you think of the revenue growth of the companies in your EMQQ?
Well, I think that valuations, inseparable part of the investment decision, and valuations right now in the emerging markets internet space and the EMQQ index are at not all-time lows, but pretty darn close to all-time lows. And the PEG ratio, which is I look at, which is the PE divided by that growth rate, is about 0.75, which is half of the U.S. tech leaders and a third of the valuation of the S&P 500. So, it's pound the table time on the PEG ratio. You also, in addition to the fundamentals, you have market sentiment, and sentiment's been terrible for the emerging markets internet companies because China dominates the index, and China's sentiment is, very, very poor right now. And as we say in Omaha, you pay a high price for a cheery consensus, and you get your best buys when people are scared. And I have never experienced a day in my career where fear was as high as it was at that end of July. And on July 27th in particular, fear was everywhere. And when I was young, they told me to buy fear, and that it's hard for people to do, but that's when you buy. And so I was pounding the table that day between talking with spooked investors, because all of the things people were worried about, I thought most of them were actually good for the China story long term. And I know that they were greatly affected investor sentiment, but I thought they were pretty much across the board good things that the government had done for the long-term story. So I think we're up a little bit from those lows, but I think the valuations are very, very compelling. And if you have 3 or 5 years, I'm quite confident you'll do well in the emerging markets internet companies from today's prices.
Yeah, we would certainly be on side with you on that. And I think some people want to wait to see 1, 2, 3 months worth of, the trend going back in the direction that they want before they step in. Others might choose to start averaging in more now. Everyone's got their own way of doing it. One thing I want to mention to people again is just the differentiation between portfolios. So some people think every tech fund is the same, and of course, if you look under the hood, you see, well, actually, they're not. From a differentiation point of view, the NASDAQ 100 index compared to the OGIG index are very, very different. OGIG is approximately 80% different than the NASDAQ 100. So people own a NASDAQ 100 tracking fund. Fine, nothing really wrong with that. It's a little bit older tech. It's a little bit more in different tech spaces than OGIG. OGIG being in internet services companies, US, global, including some China, some rest of the world. What's also interesting is how different EMQQ is from OGIG. So also very internet focused, but because it is emerging market focused, it turns out to be 80% different than OGIG. And so one suggestion for people to consider this is own a mix, whatever the mix that's right for you, your clients. If you're an advisor, is up to you, but it's fine to own NASDAQ 100 tracking funds. We think it's equally important to own some of the higher growth new technology stocks that you find in OGIG, and emerging markets we think is really important for investors. It's a little bit like a century ago in Europe. Investors who did not invest in the United States made a huge mistake, obviously. And the US has had 100 years or so of a really strong economic performance, equity market performance, and quite likely the investors who did allocate to the US, quite happy they did so. So now we got China, it's emerging, it's growing, whether you like it or not. It's quite likely to continue to be a very big population and have a lot of economic growth. Own a bit of it, get some upside, make that your win out of whatever's going on in China is one way to look at it. And so we would just encourage people to think of it that way. I want to show people one more slide, which is the importance of revenue growth. And we have a index process for OGIG that is based on a lot of research to determine what kind of stocks in the internet services space, what kind of stocks do better than average. What are the metrics that help identify the stocks that do better than average or that do well? And this shows you why revenue growth, why we feel it's so important. Stocks that have stronger revenue growth have had stronger performance. The stocks in the first quartile by revenue growth have had that much stronger performance, 53%, compared to second, third, fourth quartile. You see going down from 53 to 30 to lower numbers. And so it's all about the revenue growth is our view of really, really important characteristic. In OGIG, stocks are selected for revenue growth. And like in EMQQ, maybe the selection process is a little bit different. Let me give you a minute, Kevin, to talk about the selection process for the stocks that are in EMQQ.
Well, our selection process is pretty straightforward. We own every single publicly traded, emerging or frontier market internet company, as long as they meet our market cap and liquidity minimums, and then it's market cap weighted. So if you're a publicly traded internet company, if you're the Google of Russia or the Uber of China or the pick your FANG equivalent, we'll own you. And right now there's 118 of those companies. And when we launched 6.5 years ago, there was only 42. And we don't screen specifically for revenue growth, but the reason we made EMQQ and our confidence long-term performance is because I think it has the fastest growing. I think the emerging markets internet sector is the fastest growing sector ever in terms of public companies and their revenue. I mean, the last 11 years, the average annual revenue growth has been almost 38%, which is hard to do. And so revenue growth is the most important thing, but earnings growth ultimately is what you're after. And you can't grow your earnings without your revenue growing. So when we look at the PEG ratios, we look at the PE versus revenue growth.
So Interesting what you said about the revenue growth rates, and we see that in the metrics. We ran a quick report. Advisors who would like to get it can send us a note, info@oshares.com. We'll be able to send it to you. We basically took a look at all of the components in EMQQ and in OGIG, shows people the overlap, or essentially the differentiation really being about 70%. And it shows the revenue growth. And in both cases, the forward revenue growth, so trailing is great. They're both over 40% trailing revenue growth. The forward revenue growth in both cases, over 40% on a forward 1-year basis. And what that essentially indicates is the revenue growth is expected to continue. These are estimates that are aggregated out of Bloomberg, where Bloomberg basically takes the inputs from so many research analysts that cover these different stocks. So it's not a matter of our opinion, it's more a matter of the aggregate opinion of the crowd, of the analysts that are covering all of these different stocks. Those that are in your EMQQ, that are in our OGIG. Over 40% trailing, over 40% forward 1 year, and that's in both cases. So I really encourage people to ask us for that. Kevin, before we go, where can people get more information on EMQQ? Your website's terrific. Maybe that's the place to start. What would you suggest?
Well, that's where you can find us, emqqetf.com, and you can also find me on LinkedIn.
That's great. And any closing comments on your outlook for the rest of this year and into next year?
Yes, I would say that there's a new chapter coming for the emerging markets and global internet space, and it's what's happening outside of China in emerging markets. China's e-commerce market is 4 times the size as the rest of the emerging markets, India, Brazil, etc. But what's happening in the non-China part of the emerging markets internet space is a very incredible story is shaping up, and the IPOs are coming fast. There's now more non-Chinese emerging market internet companies than Chinese, and the IPOs are coming from Turkey, from Uruguay, from Kazakhstan. Everybody's got their own localized Uber and their own localized Amazon, and it's getting quite exciting. So you'll see it in the papers as the India IPO pipeline starts to pour out exciting internet companies.
And so I guess EMQQ is a way people can get some exposure to those new names as they go public and meet your criteria.
Yes.
Great. I'm going to ask the producer just to bring that valuation slide back on, because this is kind of my closing comment for people. I think going back to the one with the line chart, please, would be great. Yeah. So Kevin made the point about what they say in Omaha, and buy when there's fear in the streets, or that type of thing. A lot of headlines generated this sell-off in tech stocks generally, some of them China, some of them others. The OGIG index is now the most attractive, or I should say, discounted valuation level of many, many years. So think about that when you're just thinking about allocating. The Omaha comment and where we are on this relative valuation cycle. If people think the NASDAQ 100 index is quite expensive, well, here's a somewhat similar zip code that is on a relative value basis, not as expensive as it has been relative to the NASDAQ 100. The second thing is to take a look at the next chart, this bar chart. It shows you the revenue growth rates of the companies in the OGIG index. These companies are growing. They are doing well. The growth rate looks to me like it's accelerating. So think about those things that you're allocating. Think about old tech versus new tech. We'll call NASDAQ 100 a little bit more the old tech. OGIG, a little bit more new tech. EMQQ is a little bit more new tech in the EM zip codes. So I think there's a place in people's portfolios for all of these different strategies. And for each advisor, each investor, think of the mix and probably be carefully about not leaving any out, because you think back a century ago, the Europeans who didn't invest in the US probably regret having made that decision. So diversify, choose your mix, and I think own a piece of each of these investment opportunities. So Kevin, thank you very much. Thanks to the audience for being with us. Reach out to our 2 firms for more information on EMQQ from Kevin's firm and OGIG from O'Shares. Thanks, everybody.